Japan's lost decade, an economic disaster. Japan's lost decade was a time in its history when the economy was mysterious and unstable. Come with us as we tell the exciting story of one of the worst economic downturns in modern times. Japan was once seen as an economic powerhouse. So how did it get stuck in a rut for more than 10 years? What caused this long-lasting problem, and why didn't traditional solutions work to get the economy going again? Join us as we delve into the heart of Japan's lost decade and look at the economic mistakes, cultural factors, and global forces that shaped this terrible period. Are you ready to find out what we can learn from Japan's economic disaster? Cycles are a part of economies with free markets. When expressed in terms of a country's gross domestic product (GDP), economic cycles are made up of varying intervals of economic growth and recession. Economic cycles, or intervals of expansion against contraction, can differ significantly in duration. A recession is traditionally defined as 2 or more quarters in a row in which the gross domestic product declines. In addition, there are protracted periods of economic contraction known as economic depressions, like the Great Depression of the 1930s. Japan went through Japan's lost decade, a period of price deflation and economic stagnation, from 1991 to 2001. Although the Japanese economy grew throughout this time, it did so much more slowly than the economies of other developed countries. The Japanese economy was beset by a liquidity trap and a credit constraint during this time. Japan's once booming economy underwent a notable slump from around 1991 to 2001, a period known as the lost decade in Japan history. The Bank of Japan (BOJ) raised interest rates in an effort to calm the real estate market, which contributed to the economic slump. A credit crunch was developing when the BOJ's policies produced a liquidity trap. A couple of the takeaways from Japan's lost decade are reorganizing bank balance sheets with public funding and avoiding stagnation brought on by inflation and deflation. Recognizing the lost decade real estate crisis in Japan. Japan's economy grew at an average yearly pace, as measured by GDP, of 3.89% in the 1980s, compared to 3.07% in the US, making it the envy of the world own. But during the 1990s, Japan's economy encountered difficulties. Beginning the fall of 1989, Japan saw the collapse of its stock and property booms. Between late 1989 and August 1992, equity prices fell by 60%, while land values fell steadily throughout the 1990s, reaching an astounding 70% by 2003. Because of this, the GDP of Japan increased by just 1.14% yearly between 1991 and 2003, far less than the GDPs of other developed countries own. The interest rate errors made by the Bank of Japan. The Central Bank of Japan, the Bank of Japan (BOJ), is widely believed to have committed a number of errors that could have exacerbated and prolonged the adverse consequences of the bust equity and real estate booms. For instance, monetary policy was stop and go due to concerns over inflation and skyrocketing asset values. The late 1980s money supply restraints implemented by the Bank of Japan may have played a role in the stock market bubble implosion. The BOJ kept raising interest rates despite declining equity prices because it was still worried about real estate values rising. The end of growing land prices was partly attributed to higher interest rates, but they also sent the economy into a downward spiral. When land and equity values dropped in 1991, the Bank of Japan abruptly changed its strategy and lowered interest rates. However, it was already too late. A credit crunch was beginning, and a liquidity trap had already been established. The trap in liquidity. A liquidity trap is a state of the economy when investors and households hoard cash, either in short-term accounts or as actual cash on hand. They may act in this manner for a number of reasons. Either they don't think investment would yield a greater rate of return, they think deflation, a decline in prices, is imminent, cash will appreciate in value in comparison to fixed assets, or they think deflation already exists. Due to the strong correlation between the three, investor and household views actually come to pass. Low interest rates lose their effectiveness as a monetary policy tool when there is a liquidity trap. No one spends money or makes investments. They wait to buy because they expect prices for products and services will drop tomorrow. They also assume that holding onto their money will yield a higher return than investing it. For the most of the 1990s, the Bank of Japan maintained a 0.5% discount rate, although this did little to boost the country's economy while deflation continued. 6. How to escape a liquidity trap? To escape a liquidity trap, fiscal and monetary policies can be implemented, but spending and investment by individuals and companies are still necessary. Budgetary measures. Fiscal policy is one tool to persuade them to do so. Governments can directly benefit citizens by lowering tax rates, issuing tax refunds, and increasing public spending. Japan experimented with a number of fiscal policies to escape its liquidity trap. It is widely held, meanwhile, that these policies were poorly implemented, with funds going to failed companies and squandered on ineffective public works initiatives. The majority of economists concur that proper money allocation is necessary for fiscal stimulus programs to be successful. Put another way, put money in the hands of customers and let the market determine where they want to invest and spend. Expanding the money supply. To escape the liquidity trap, one alternative is to re-inflate the economy by raising the money supply in real terms rather than focusing on nominal interest rates. By buying government bonds through open market operations, a central bank can infuse money into an economy regardless of a set target interest rate, such as the Fed funds rate in the United States. When a central bank buys a bond, it essentially converts the bond into cash, increasing the amount of money in circulation. The term monetization of debt refers to this. It should be mentioned that target interest rates are likewise reached and maintained by open market operations. However, a central bank does not take a target interest rate into consideration while monetizing debt. The Bank of Japan started focusing on the money supply in 2001 rather than interest rates, which assisted in taming deflation and promoting economic expansion. 5. Banks are left with extra cash on hand when a central bank adds money to the financial system, but they also have to be willing to lend that money out. This takes us to the next issue that Japan had to deal with, the credit crunch. The financial crisis. A credit crunch is a state of the economy where banks have tightened their lending standards and largely stopped lending. A few reasons why financial firms would not lend money are as follows. Requirement to retain reserves in order to restore bank balance sheets following losses, as experienced by Japanese banks with significant real estate investments. Less risk-taking was the result of financial institutions that had initially lost money on lending subprime mortgages pulling back on lending, deleveraging their balance sheets, and overall trying to lower their risk-taking levels in the United States in 2007 and 2008. A free market economy is dependent on prudent risk-taking and lending. When money is invested, however, it is challenging for the economy to expand while banks are hesitant to lend. Similar to how a liquidity trap causes deflation, a credit crisis fosters deflation by discouraging banks from making loans. As a result, firms and consumers are unable to spend, which drives down costs. A credit crunch is similar to a liquidity trap in that it causes deflation because banks are reluctant to lend. Reduced lending indicates a decrease in the amount of fresh money entering the economy, which drives down prices even further. A few potential remedies for a credit crunch are listed below. Restructuring banks. Japanese banks were reticent to accept losses during the 1990s credit crunch. Banks were given public cash to reorganize their balance sheets, but they were unable to do so due to a fear of losing control to foreign investors and the stigma attached to disclosing long-hidden losses. 7. In order to escape a credit crunch, bank losses must usually be acknowledged and the banking system must be open and honest. Banks must also have faith in their capacity to evaluate and control risk. Combating deflation. Deflation is a major issue since it leads to investors and consumers hoarding cash because they believe it will increase in value over time. Bank losses result from a decline in the value of collateral-backed loans when asset prices decline. A credit crunch may result from banks cutting back on lending when they experience losses. Generally speaking, inflation can be a concern for the economy since it raises prices and reduces consumer purchasing power. Reinflating the economy, though, might be required if Japan is to avoid extended spells of poor development as it did during the 1990s. Money helicopter. Reinflating an economy is very difficult, particularly if banks are unable or unwilling to lend. The idea that a central bank could drop money from a helicopter is what gave rise to the term helicopter money for this practice. Subscribe now to stay informed and join us on a journey through the intricacies of economic resilience and recovery. Together, let's learn from the past to build a stronger future.